Brad Williams, Frugal Finance, passive income versus residual income. Key differences explained. Income refers to the money that individuals or businesses earn in exchange for providing services or making investments. Two common categories of income are passive income and residual income. Though the terms are often used interchangeably, they are not the same. Passive income can be a type of residual income, but not all passive income qualifies as residual income. Here's a breakdown of each term and their differences. What is passive income? Passive income is money that comes in with little outgoing effort or active participation. Once set up, this income stream requires minimal effort to maintain. Examples of passive income include dividends from investments, rental income from properties, or earnings from a peer-to-peer lending platform. To qualify as passive, income is typically derived from an investment or business venture that does not require direct involvement in day-to-day operations. For instance, owning a rental property may provide passive income, but only after the upfront effort of acquiring and setting it up. The appeal of passive income lies in its ability to generate ongoing revenue without continuous work. If a passive income source is substantial enough, it can even replace active income, granting more time for other pursuits. However, setting up a passive income stream often involves upfront costs, whether in terms of money, time, or both. What is residual income? Residual income refers to the amount of discretionary income an individual or entity has after all financial obligations, such as bills and debts, are paid. This concept plays a critical role in personal finance and corporate evaluation. It is calculated by subtracting expenses, including living costs or capital expenses, from the total income. In personal finance, residual income helps assess creditworthiness. Banks and lenders look at how much residual income an applicant has left after expenses to determine their ability to handle additional debt, such as a mortgage. The residual income calculation in this context excludes basic living expenses like food and utilities. In corporate finance, residual income is the profit a company generates after covering its capital costs. It helps gauge a company's performance and is used in assessing investment opportunities. Similarly, in equity valuation, residual income is used to estimate the value of a company by adding its book value to the present value of expected future residual income. Passive and residual income, how they differ? While both terms can involve money earned with a little active effort, they are not interchangeable. Passive income is more specific, referring to revenue from investment or enterprises with minimal daily input. On the other hand, residual income is more about what's left after expenses are settled. For example, if you own a business, your residual income would be the profit remaining after all business costs are covered. As an individual, your residual income is the leftover amount after paying your personal bills and debts. While residual income can sometimes be passive, like rental income, it is not inherently so. Generating passive income? There are several ways to start earning passive income. These might include renting out property, selling creative works like photographs or crafts online, or investing in stocks. For those interested in growing passive income streams, it's crucial to understand the upfront effort required, such as purchasing property, learning about investments, or creating digital products. Active income versus passive income? Active income, unlike passive income, requires consistent effort. This income comes from working in a job or business where you exchange time for money, such as through a salary or higher wages. With passive income, the goal is to set up a system that can generate revenue with minimal ongoing effort, freeing up time for other pursuits. Tax implications for passive and residual income? Both passive and residual income are taxable, but they are treated differently. Passive income is often taxed at different rates depending on its sources, such as real estate or investments. Residual income, which stems from active income, is generally taxed at the same rate as earned income, though it may influence how much taxable income remains after expenses. Final thought, though passive income and residual income are often used interchangeably, they refer to different concepts. Residual income is what's left over after covering all your financial obligations, while passive income represents earnings from ventures that require minimal ongoing involvement. Passive income streams, such as rental income or dividends from investments, often require significant initial effort and investments, but can provide long-term financial benefits. By using residual income to fund or support passive income activities, individuals can build streams of income that support their lifestyles with less day-to-day effort. With the right planning and resources, investing in passive income opportunities can be a powerful way to create additional financial security. If you have any questions or comments about passive income versus residual income, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.